Welcome to this deep dive into credit ratings and default probabilities. When we look at credit ratings for larger publicly traded bond issuers, these are typically provided by rating agencies as indicators of credit quality. These agencies aim for stability to avoid frequent changes based on short-term noise, taking a long-term view known as rating through an economic cycle. This means a rating might stay the same even if there is a higher likelihood of default within the next year, provided the overall change over the subsequent 4 years remains insignificant. However, rating agencies typically do not provide ratings for small and mid-sized firms. For these companies, lenders develop their own internal credit rating systems. These systems look closely at profitability through measures like return on equity, liquidity via the quick ratio, and solvency through the debt-to-equity ratio. Because borrowings must be repaid with cash, lenders use company-prepared financial statements as a starting point, adjusting them to create a cash flow statement which is essential for determining a firm's true repayment ability. To quantify these risks, we use Linear Discriminant Analysis, or LDA. This is a popular statistical method used for developing credit scoring models where a scoring function is a linear function of variables produced by the LDA. The variables are chosen based on their estimated contribution to the likelihood of default and come from an extensive pool of qualitative features and financial ratios. A primary application of LDA is the Altman Z-score, which is used to predict defaults. Initially devised for publicly traded manufacturing firms, its reliability has been confirmed throughout of sample data with very few errors, and it has since been refined for private firms. The model uses 5 specific financial ratios. X1 is working capital divided by total assets, X2 is retained earnings divided by total assets, X3 is earnings before interest and taxes, or EBIT, divided by total assets, X4 is the market value of equity divided by the book value of total liabilities, and X5 is sales divided by total assets. The contributions of each ratio are weighted into the overall score using the formula Z equals 1.2x1 plus 1. 4x2 plus 3.3x3 plus 0.6x4 plus 0.999x5. In applying this LDA to classify firms based on credit quality, we follow specific guidelines. If the computed Z-score is greater than 3, no default is likely. A score between 2.7 and 3 indicates a potential default. A score between 1.8 and 2.7 suggests a reasonable probability of default, and a score below 1.8 indicates a high likelihood of default. Ultimately, the higher the score, the more likely the firm will be classified as solvent, while a lower score indicates the firm is moving toward being insolvent.